Valuation is a very important topic in strategic financial management, such that you can't go to the exam hall without your deep knowledge of business valuation. Um, of all the topics in strategic financial management, valuation is the most frequent topic that is being tested by ICANN. Every diet, you must have a question under valuation, majorly as compulsory. If not compulsory, you will see it either in section B. So what that means is that is a very important one, but the dynamics of the question may be different diet by diet. But that's why it is important as a student, when you are going to the exam hall, you need to be prepared. You need to prepare for the unknown. You may be thinking that ICANN may bring out a calculation of a particular topic, and they go as well and set the theory out for you to discuss, to explain, And then if you are a type of person that doesn't like story, you like calculation, then you have to improve on that going forward. Because this is a kind of exam that you don't want to take with liberty. So you want to take it very seriously. Therefore, my people, I will encourage you, please go ahead across all the topics in SFM, even across other subjects. Don't rely too much on calculation, because you may be with the way the economic trends, and with the way things are going across the world, there is likelihood that this particular diet ICANN may do more with theoretical questions other than calculation. And therefore, you have to expose yourself. You have to expose yourself. So let's dive in straight to the topic of the day. So today we are going to be looking at merger and acquisition, and then majorly business valuation. So generally, when it comes to merger and acquisition, it's purely theoretical. There is no calculation in merger and acquisition, but you have to understand, if not for the exam, but for your personal development, you need to understand the details or the dictate of merger and acquisition. What do you mean by merger? What is merger? What is acquisition? All right. What are the forms of merger? Okay. What do you understand by the what are the types? Like I said, what are the types of merger? Okay. What are the types of merger? Not only that, for each of the type of merger, what are the advantages and disadvantages? Not only that, you need to know what are the reasons for merger. How do you carry out due diligence? What are the forms of due diligence? Okay. What is synergy? What are the advantages and disadvantages of synergy? What are the tactics, the defensive tactics in merger and acquisition? Okay. So all these items, you need to know them. Examiner can ask you, why do you think that merger and acquisition transactions or deals fail? Why do merger and acquisition fail? All these things, you need to know them. So it is purely theoretical, and it's my nature. And because of the fact that we have a lot to do, the essence of setting up this class is for us to be able to ensure that we finish on time. This coming Saturday, according to officially, we are supposed to complete. I'm supposed to complete my class with you on April 13th, which on Saturday, then April 14th on Sunday for a solo student. But because of the fact that, of course, it's a whole lot. So I have to set up this online so that everybody will be at par. Because if I were to go to VHI I won't be able to attend to online. I won't be able to attend to a solo student. If I go to a solo, I won't be able to attend to VI or online student. If I decide to do only online student, I will be able to take care of my VI and a solo student. And that's why I have to bring everybody together. At least if today we're able to complete about 4 hours, that will reduce our burden when else we are meeting so that we can quickly complete that. So without wasting more time, please, I want to encourage you, go ahead with this material, go and study, go and read about all the theoretical aspects of merger and acquisition. So because merger and acquisition is just a subset of valuation, where you have the major work is under valuation, and you have to expose you to different ways examiner can test you under valuation. So we are going to take it one by one. So again, please go ahead, go and read about valuation, merger and acquisition. They are very interesting, very, very interesting. It's going to help you. At least you have idea what merger and acquisition is all about. Okay. And then again, you may also want to go through the link I share with you on my article on the benefits of the downside and upside of recapitalization that the CBN introduced in recent time. And that's in 2004/2005, when there was that recapitalization of bank. The subsequent diets, ICANN tested merger and acquisition. Okay, so I will show you the question that was tested then. Till today, that question is still valid, and similar thing will play out in this coming diet. In this coming exam. Okay, but when we get there, I will inform you. So please do well to go through all of this. Need to go through all of this so that you have the idea, especially as it has to do with the synergy and all of that, because the main target of merger and acquisition is to be able to create additional value for the equity holders, okay, for the equity holders. So it is believed that synergy, the potential synergy from coming together of two companies will create the intended synergy for the business, which will invariably maximize the wealth of the owners. So that is for that. Please do well to go through all of this. They are very vital. Go through them. So let's go to valuation straight. What do you understand by valuation? Simply put, valuation represents the process of determining the economic worth of a company or of a company's share. I repeat, valuation represents the process of determining the economic worth of a business or of a company's share. Now, what are the purpose, to save time, what are the purpose of valuation? What are the purpose of valuation? What are the reasons for valuation? There are some reasons for valuing a business. One is for estate and tax purposes. You value a business for estate and tax purposes. For example, when a company, when somebody dies and leaves an estate, of course, the administrator will need to determine the value of the business for them to be able to know how much of the estates will be available for distribution to the beneficiary that the deceased has left behind. Not only that, you need to know how much tax are you going to pay on the estates. So as a result, you need to value the business accordingly, the estates accordingly. Then two, valuation is carried out when there is merger and acquisition. So when two businesses are coming together, there will be need to know the worth of individual company. Company A and B are coming together. So you need to know what is the worth of company A, what is the worth of company B. If you don't carry out the valuation, you will know how much price to pay. All right. So in valuation, in merger and acquisition, valuation is also needed. Number three, valuation is carried out whenever there is shareholder or partnership dispute, whenever there is partnership dispute. So when a partnership business is about to be dissolved, then you need to know the value of the business, of the partnership business, so that we know how much will be attributable to each partners uh, from the assets of the business. Again, valuation is carried out when there is marital dispute. Okay, when there is marital dispute or when there is divorce. This does not happen in Nigeria. I've never seen it. I've never heard it anywhere that in Nigeria that when partners uh, dissolve their marriage and then the assets of the leading partner uh, will be valued. Then from there, it will be shared between the two so that we know how much of the estate of one of the leading partners should be given to the other. It happens in the Western world, but in Africa, I've never heard it. When you look at most of um, the VIPs, for example, the Bill Gates, the Elon Musk, what's the name of this guy, this Apple guy, all of them, they have divorced and their estate were shared. Okay, their estate were shared between the spouses. So, and this is what we are saying. But again, here in Nigeria, it doesn't work like that. It doesn't work like that. Anyway, move on. Then you also value a business for the purpose of when there is litigation. Another reasons for valuation is litigation. So uh, litigation can arise between companies and vendor, between principal and agents, between landlord and the tenants. Okay, there could be a litigation between those parties. So when there's a litigation, the court may want to know the value of the disputed assets so that the judge will know the appropriate judgment to be placed on the case. So when there's litigation, yes, we value a business or for a business assets. Then when there's stock exchange listing, when the stock valuation is carried out, when there is stock exchange listing, when a company is going for initial public offer for example, you need to know the value of the business. All right, you need to know the value of the business. Then, when a company wants to, when there is there's also valuation. Valuation is carried out for the purpose of bank loan or bank lending. When a company needs finance and you approach your bank, it's one of the requirements, especially if it's a big sum of money. So your banker may want to know what is the worth of your business. If you say you need so much, how do I rely? So what is your what's your worth as of today? So valuation will need to be carried out for purpose of bank lending or bank loan. All right. So these are some of the reasons for valuing a business. So you can go through the material, you see them there. However, the major work, where we have major work is valuation methods. What are the valuation methods? So for this purpose, I will stop sharing this document, then I will move to my working notes so that I can explain to you step by step what you need to do under each method of valuation. Okay, so yes, let me confirm this is working. All right. Methods of valuation. There are basically three methods of valuing a business. There are more than that, but the most common one are the ones I'm going to give to you, and which are the most, relevant method of valuation. One is asset-based approach. There is asset-based approach. Two, income-based approach. Number three, discounted cash flow based approach. So these are the three methods of valuing a business or of a business share. So let's take it one by one. Asset-based approach. So when you talk about asset-based approach, this is a method of valuation that relies heavily on the net assets of a business in the valuation of a company's, in the valuation of a company's. So the asset-based approach relies heavily on the use of net assets for the purpose of valuing a business, which represents, net assets represent the total assets less total liabilities. So for the asset-based approach, like I said, because of time, don't let me write all of this thing down. So, like I said, the asset-based approach relies heavily on the use of net assets in valuing a business. For this purpose, net asset represents the difference between total assets and total liability. In the valuation of a business using net asset basis, only the tangible assets are considered. Only the tangible assets are considered. And tangible assets are assets that can be moved, assets that can be moved, touched, and seen, like motor vehicle, land and building, furniture and fittings, equipment, and stuff like that. Which means that intangible assets like goodwill, copyright, patent rights are ignored, are not considered in valuation. You don't use intangible assets for the purpose of valuation, except they have market value. You can only consider intangible assets if they command a market price, if they have a market price. Other than that, you don't include intangible assets. However, there are four categories of asset-based approach in valuation. I repeat, in valuation, there are four categories of asset-based approach. One is book value basis. Book value basis. Two, replacement value basis. Three, realizable value basis. Then four, liquidation or breakup basis. So let's take it one by one. What do you understand by book value basis? The book value basis value a business on the basis of the net assets of the business by considering the face value, the historical value of the asset of the company.
Sir, please, can you recap again, please?
For book value basis, this represents the valuation of business on the basis of the book value or historical value of the business assets, and liability. Okay, of the assets and liability of a company. Okay. Now, like I said the other time, when you want to calculate the book value, just go to the balance sheet or the statement of financial position of the company. You pick the tangible assets, the value of the tangible assets as you have it in the balance sheet. For example, you go to the non-current assets, motor vehicle. What amount do you have in the balance sheet? You put it down. Furniture and fittings, how much do you have in the balance sheet? You put it down. So you are going to add up all the non-current assets, including the current assets. You add all of them together. You have your total assets. Then you go to liability, add up all the liabilities together. So the difference between the total assets and the total liability will make up the book value. The book value is the net asset of the company. Majorly, examiner may not ask you this one to use book value. Examiner may not ask you to use because it's there in the balance sheet that will be given to you. The book value is even there, except that if examiner has hidden something there and then don't want you to go and unravel it. But in most cases, the book value, balance sheet that will be given to you, you can see the book value there. All right, just pick the numbers, total assets, and then total liability, find the difference. That will give you the net assets, okay? So if that, let me just add to that. This represents the net assets of a company. That's the net assets. Total asset minus total liability. All right then. So examiner may want you to determine value per share. So for you to get the value per share, therefore, your value of a company valuation would then be equal to net assets divided by number of shares. So that will give you the value per share. If you are not given number of shares in the question, then valuation is equal to the net assets. So that's that. So using a book value basis, this is how to calculate the value of the business. Net asset divided by number of shares, or simply put, net assets if number of shares is not given. The second one is replacement value basis. Number B, replacement value basis. This is a method of this value a business similar. This value a business the same way. Okay, let me reword that. The valuation of a business is carried out similar to the book value basis, except that all the tangible assets will be replaced with the replacement value. Okay.
Hello, sir.
Yes.
Hello, sir. Please, can you help attend to Chidima in the chat list?
Chidima. So can you recap the definition of valuation? Okay. Kingsley, you want me to recap the definition of valuation. I said valuation is the process of determining the economic worth of a business or of a company's shares. The process of determining the economic worth of a business or of a company's shares.
Yes.
Then
Hello, sir. Good morning. Sir, please, what chapter in our material are we on? I just joined the group and I'm lost like this.
go to if you have the hard copy, go to valuation.
Yes.
Merger and acquisition. So we are just starting the elementary.
Okay, under merger and acquisition.
Yes.
Okay.
And I also share this one.
I was looking for only valuation.
It's all right.
All right, thank you, sir.
So, all right then. Yes, let me explain further under the replacement value. When you want to value a business using replacement value basis, so you are going to calculate the same way you calculate the book value basis. But the only thing is that the replacement value, you are going to change the book value. Instead of using the book value, you are going to use the replacement value for the valuation. Say, for example, in the balance sheet, you have motor vehicle that's worth 5,000 naira. You also given plants and machinery that are worth 3,000 in the balance sheet. This is balance sheet information. Then, when you want to value a business using replacement basis for all the categories, apart from book value, examiner will give you different numbers, different from what you have in the balance sheet. So for the replacement value, examiner will give you a different number. For the replacement value, examiner may tell you that the motor vehicle is 3,000 naira. The plant and machinery is 4,000 naira. So when you are now calculating your tangible asset, you want to calculate your net assets. Instead of you to use the balance sheet information, you are not going to use the balance sheet number. Rather, you are going to use the replacement value. So you are going to replace, instead of 5,000, you replace 5,000 with 3,000. You replace 3,000 with 4,000. So that is how we are going to calculate the value of the business under replacement value basis. I believe that is clear. When you see live question, you understand better. Now, again, valuation using replacement value basis is equal to the company net assets. You are still going to calculate net assets. All right. You are going to calculate net assets, only that you are replacing the balance sheet information, the balance sheet figures with the replacement value. That's all. So you divide with number of shares if you want to calculate value per share. The next one is a realizable value. Realizable value basis is the same thing. For the realizable value basis, this will be calculated similar to book value basis, except that the historical value will be replaced with the realizable values. Okay? This is calculated similar to book value basis, except that the historical values will be replaced with the realizable values of some of the tangible assets. Okay, so that's that. Under this, valuation is equal to net assets. If you are asked to calculate value per share, then your net asset divided by number of shares. Okay, so again, just like I explained here, in this case, examiner will give to you the realizable value. You are going to be given the realizable value. So examiner may tell you that the realizable value is, for motor vehicle, for example, is 6,000. All right. The plant and machinery is 2.5. So what that means is that I will replace the balance sheet value. Instead of 5,000, I will use 6,000. Instead of 3,000, I will use 2,500. All right. So that means you are replacing the book value with the realizable value. The last one under this category is breakup basis. Breakup basis liquidation or breakup basis. When it comes, this is the value. This represents the valuation of a business asset. When there is liquidation, or when a company liquidates. This represents the valuation of a business asset when the company liquidates. Now, when a company liquidates, there will be need to value the business assets so that we'll be able to settle the creditors from the proceeds therefrom. Therefore, in order to know the true worth of those assets, there will be need for valuation. Okay, so the valuation using breakup basis represents the amount at which the tangible asset of the company can be disposed, can be disposed at break-up basis. Okay, can be disposed at break-up basis. All right. So that is for that. Again, valuation under this is the same thing. Net assets you are calculating equal to net assets divided by number of shares. Okay, so these are the 4 categories of valuation under asset-based approach. These are the 4 categories. They are very simple and straightforward. And since 2014 up to date, ICANN has tested asset-based approach like 3 times, like 4 times. Yeah, ICANN has tested asset-based approach like 4 times. Okay. So even though it's very straightforward, but ICANN will also always look for something. You go and hide something there and they will allow you, throw you into the feed. Go and be searching for it, like Google Ultimate Search. I'm going to be searching for the hidden figures. All right. So again, when we get there, we are going to solve an illustration and relations to this. Now, so these are what you are going to do under asset-based approach. So let's go to income-based approach. Income-based approach. Under income-based approach, there are 3 categories of valuation that we are going to, method of valuation that we are going to consider. There are, let me rewrite this. The following methods of valuations will be considered under income-based approach. Number 1, we are going to look at price earning ratio, valuation using price earning ratio. Two, we are going to look at dividend yield, valuation using dividend yield approach. Then 3, we also consider earnings yield. So these are the 3 methods of valuation we are going to look at under income-based approach. So let's take it one by one. Price earning ratio. Price earnings ratio. What do you mean by price earning ratio? The price earning ratio represents price earnings ratio represents the ratio of share price to earnings, to earning per share, to earnings per share. Price earning ratio represents the ratio of price and the ratio of share price to earnings per share. You know, in your financial statement analysis, when you want to calculate price-earning ratio, you say price-earning ratio equal to share price divided by earnings per share. So this will give you price-earning ratio. However, price-earning ratio is not our focus. Our focus is on the share price. This share price represents the value that you want to determine. Therefore, valuation using price-earning ratio represents price-earning ratio multiplied by earnings per share. Using price-earning ratio, command, valuation is calculated by multiplying the, let me remove all of this, I don't need it. By multiplying the price-earning ratio with the earnings per share, okay? The price-earning ratio is mostly suitable for a profitable organization. The PE ratio is suitable for a company with profitable history. So if a company is not profitable, you cannot use price-earning ratio, because the earnings that you want to use is the profit we are talking about. So when the company make loss, that is not a profit. So you cannot use loss to value a business. So it is only a company that is profitable that will be able to use price-earning ratio. However, the price-earning ratio valuation of an unquoted company, however, let me use that as a paragraph. However, the valuation of unlisted company may be challenging using PE since an unquoted company does not have a PE ratio. So because an unlisted company does not have a PE ratio, so it becomes problematic to use PE ratio to value such a company. So under this situation, the most important thing to do under this situation or in value an unquoted company, let me reword it. In the valuation of an unquoted company, The most important thing to do is to use the PE ratio, is to adjust the PE ratio of a comparable listed company, is to adjust the PE ratio of a comparable listed company by ratio of, or is to adjust between, is to adjust the ratio, the PE ratio of a comparable company by a ratio of 20% to 50%. All right. So what this simply saying is that because the PE ratio of an unquoted company is not available, therefore, what you are supposed to do is to look for a comparable company. A comparable company is business that operates in the same industry with almost similar size within an industry. Therefore, because the unquoted company is not listed on stock exchange, therefore, you are going to look for that comparable company operating in the same industry. You go and you borrow the PE ratio of the comparable company, then you adjust it between the ratio of 20 and 50%. Now, this is very subjective because except examiner says otherwise, if you are not told to adjust for the PE ratio of the comparable company, you are at liberty to make your adjustment between the ratio of 10 to 50. 10 to 50. All right. What's wrong with your pen? Connect. Please let me reshare. My pen is not connecting. Let me reshare, please. Again, let me reshare. Still not connecting. Close the documents. So, okay, yeah, it's back now. Sure. Okay, so my pen was not connecting before, so I have to close the document and reshare now. All right, let's move on. So like I was trying to say, when you want to value an unlisted company, you need to get the PE ratio of a comparable listed company operating in the same industry. Now, you can't just use the exact PE ratio of a comparable company. You need to adjust between the ratio of 10 and 50% because you have to consider the risk inherent in an unquoted company. Because if you use the exact PE ratio of a quoted company, that means you are assuming that both companies, both quoted and unquoted company, have similar business risks, which is not the same thing. because an unquoted company is considered to be more risky relative to a quoted company. All right. Therefore, you need to adjust for the PE ratio. You adjust downwardly for a ratio of 10 to 50 to incorporate, in order to incorporate, in order to incorporate the risk inherent in an unquoted company. Unquoted or unlisted company. Okay. So the level, the ratio of the adjustment will depend on the perceived risk. The adjusted ratio will depend on the perceived risk of the unquoted or unlisted company, which means that the higher the risk associated with the unquoted company, the lower, the higher the ratio that we are going to adjust, and vice versa. So that's that. Therefore, how do you then calculate the value of a business using price-earning ratio? Like I mentioned from my definition, valuation will be determined as PE ratio, the adjusted PE ratio. If you are doing for an unquoted company, then adjusted PE ratio multiplied by earnings. Okay, the adjusted PE ratio multiplied by earnings. But if you are doing it for a quoted company, there is no need for you to adjust the PE ratio. Just use the PE ratio of the company. But in most cases, examiner will want you to use this particular method for an unquoted company. Okay, so that's that. Again, if you want to determine value per share, just divide whatever answer you get. PE ratio multiplied by earnings, then you divide by number of shares if you want to determine value per share. But it's not going to be as straightforward as it is. It's not just about, okay, go and pick the PE ratio of a quoted company, then you now adjust, blah, 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 go to the income statement, go and pick the profit after tax. Your profit after tax is the same thing as your earnings. All right, then just go in there and pick the profit after tax. No. Examiner will hide something in this earnings. You must calculate a revised or adjusted earnings. Examiner will never give to you the earnings you have in the income statement. No. Something will be hidden for you to go and find it out. So once you have unraveled that thing that has been hidden for you, then you come and calculate the valuation. So for you to now say, okay, the PE ratio will be given to you, then you just go in there, the PE of a comparable company will be given, just go and make your adjustment. If you are doing for unquoted company, then the earnings is there in the income statement. Okay, let me just go and pick it, then multiply. It's not going to be as straightforward as that. Examiner will hide something will be hidden in the earnings that you are going to use. What that means is that you need to go ahead and calculate a revised earnings. You need to calculate a revised earning. Prosper, talk to me.
Sir, the formula you gave previously, is
Yep.
it PE ratio times earning per share or PE ratio times earnings only?
See, the formula I gave earlier when I was explaining, I gave a formula for calculating price earning ratio. Just that one is just an example. Just an example. I said PE ratio in your financial statement analysis, in a ratio analysis. PE ratio is calculated as share price divided by earnings per share. This is the formula for calculating PE ratio. So I now say that where we are going, it's not about PE ratio. It is this share price, this denominator is what you want to determine in your valuation. And that's why you have to cross multiply to get your valuation. We now say this share price, which is valuation in this case, is equal to PE. Okay, it's equal to PE ratio multiplied by earnings. So in this case, it is not going to be earnings per share multiplied by earnings. All right. So that is that. In this case, if I don't want to do it this way, of course, okay, because of time, let's move on. Abu, please, Fidelis, mute yourself. All right, then. So let's move on. Abu, you are looking for my trouble. I told you to mute you. I muted you, then you unmute yourself again.
Sir, I'm sorry. I'm so sorry, sir. It's a mistake.
So let's move on. Yes. Again, let me just recap what we have done under price-earning ratio. When you want to value a business using price-earning ratio, you are supposed to multiply price-earning ratio with the earnings of the company. In this case, the earnings will not be given to you. The earnings that will be given to you will need adjustment. You need to adjust for that earnings because there will be some additional information that will be given to you. Therefore, you are going to calculate a revised earnings or adjusted earnings. So once you are done with your revised earnings, you need to multiply with the price-earning ratio of the company if it's a quoted company. However, when you want to value an unquoted company using price-earning ratio, so you need to go and identify a comparable company. And I said a comparable company is a company that operates in the same industry with a company which have similar business risk, okay, with an unquoted company. So in this case, when you want to value a business using price-earning ratio, you want to value an unquoted company using price-earning ratio, you are supposed to adjust the price-earning ratio of a quoted company downwardly between the ratio of 10 and 50, depending on the perceived risk inherent in an unquoted company. Because if you use the PE ratio of a quoted company for an unquoted company, it means that you are assuming that both of them, both the quoted and unquoted company, have similar risk, which is not the same, which is not true. So you need to adjust for the risk inherent in an unquoted company. All right. So, and it's always very straightforward. Just multiply the PE ratio with the earnings. So the only challenging area in this case is that examiner will not give to you the earnings that will be given to you will need adjustments. So once you're able to make correct adjustments, then you are good to go. The third one is, sorry, the second one is any dividend yield. Let's talk about dividend yield. Yes. Who is that? LBK. Who is LBK? Go ahead with your question, LBK.
Okay, please, I want you to recap.
Who is LBK? What's the name?
Labake.
Labake, Omo Labake. Talk to me.
All right. You said, I just wanted to confirm this. Is it the higher the risk, as in the higher the ratio, the higher the risk?
The higher the risk, the higher the perceived risk inherent in an unquoted company, the higher the ratio that you are going to adjust. Now, this is what I'm trying to say. Say, for example, you want to value an unquoted company and you are given a PE ratio. You are given a PE ratio of a quoted company to be 10. Okay? It's 10. When you say PE ratio calculated as this, using this formula here. So the PE ratio of a quoted company given to you is 10. Now, if you want to value an unquoted company, you are at liberty to either use 10%, 15%, 20%, 30%, 40%, or 50%, depending on the perceived risk associated with an unquoted company. And that's why I said that it is subjective. A student can use 10%, another student can use 15%, then another student can use 25%. So it all depends on you. If examiner is not specific, then that means everybody will have different answers. But however, whatever the percentage that you have assumed as a ratio for the unquoted company, you have to state it. You have to state it in your working. It's very important. You have to, because you need to let the examiner understand your position. Except if examiner is specific by telling you that you should adjust, that you can adjust the PE ratio of an unquoted company with this particular percentage. Other than that, you are at liberty to assume anything. So in this case now, if it is 10, the PE ratio of a quoted company is 10, and I want to value an unquoted company, I will just say 10. Say, for example, I want to use 15%. That means I'm supposed to account for 85% of 10. That means I'm going to use 8.5. So I'm going to use PE ratio of 8.5. If the perceived risk, if I think that the perceived risk of an unquoted company is 30%, that means I'm supposed to account for 70% of the PE ratio of a quoted company. In this case, my revised PE ratio will then be equal to 10 multiplied by 70%, because I'm accounting for 70% of the PE ratio, which is going to be 7. If I think that the PE ratio, I mean the risk associated with an unquoted company is lower, possibly, let's say, is 20%, for example, then I'm supposed to account for 80%. I would then say PE ratio equal to 10 multiplied by 80%. So that's how you are going to make your adjustment. I hope that is clear, Labake. Okay.
Yes, thanks.
So let's consider dividend yield basis. What is dividend yield? Dividend yield represents the ratio of dividend to share price. Emmanuel, go ahead. Emmanuel, go ahead with your question. You are not ready.
Hello, sir. Can you hear me? Hello, sir.
Go ahead. I can hear you. Emmanuel, go ahead. Iman? Okay. Dividend yield basis. When you talk about dividend yield represents the ratio of dividend to share price. We have done it previously under cost of capital. Dividend yield is the same thing as cost of equity. Okay? So dividend yield represents the ratio of dividend to share price. Therefore, the value of a business, the valuation of a business using dividend yield represents the present value of future dividend, present value of future dividend payment discounted discounted at the yield, discounted at the dividend yield, or rate of return. Okay, that's that. So it is calculated as follows. Valuation using dividend yield can be calculated as follows. Depending on the nature, or depending on whether dividend is constant or there is growth. In dividend payments. Okay. So there are two different ways examiner can test you. There are two different ways question can come out under dividend yield, depending on the nature of the dividend. For example, where dividend is constant, where dividend is constant. Emmanuel, I'm still waiting for you to come up with your question. You raised hand the other time, but you did not talk. So where dividend is constant, then value of a business, valuation, is calculated as, let me remind you, when we did cost of capital under cost of equity, I demonstrated for you that equity value, cost of equity equal to where there is no growth. Cost of equity equal to constant dividend divided by XDIV share price. Simply put, share price multiplied by 100 over 1. This is the formula I gave to you, right? So, and I also demonstrated for you that when we get to valuation, that we are going to calculate value of a company. You are going to calculate the market value of a company's shares. So using dividend yield. In this case, all I need to do is to just cross multiply, because this share price, all these ones are their value per share, dividend per share, share price. Okay, so they are par value. So if I want to get the value of the business, all I need to do is to just cross multiply. So your KE, this KE is the same thing as dividend yield. KE is the same thing as dividend yield. Therefore, the value of a business will then become the dividend, the ratio of dividend to dividend yield. If you look at my definition, I said the valuation of a business using dividend yield represent the present value of future dividend discounted at the yield or the rate of return. So you want to discount the future dividend. In this case, this will now be dividend divided by dividend yield. So this represents valuation. Watch out for this formula, but in this case, it will be the one that has growth, especially now that recapitalization is, of banks is ongoing. So watch out. You have to watch out. It's me, because the question that may come out may relate to, if at all, may relate to dividend yield. Okay, because shareholders will need to know how much dividend they intend to get going forward. okay, from the combining businesses, because as it is, the recapitalization will birth a new, bigger, stronger, and netter banks. So as a result, businesses will combine together. Banks will be acquired or merged with another company or with another bank. So as a result, when you are valuing the business, you may need to consider using the dividend yield basis. So now that's what I'm suggesting, that it's possible ICANN may test this diet, okay, may test valuation this diet, especially using dividend yield. Examiner can also give you, may I give you a scenario, then ask you to use different techniques, using dividend yield, using price earning ratio, using whatever the techniques that examiner may want you to use. Okay, so move on from there. So this is how to calculate value of a business using dividend yield. It's just the ratio of dividend to dividend yield. This dividend yield is the same thing as cost of equity. It's the same as cost of equity. Then the second one, where dividend is growing, where there's growth, where there is growth in dividend payments. So in this case, the formula will change. You need to introduce growth. So valuation will then be equal to dividend, the current dividend, multiplied by 1 plus the growth rate, divided by dividend yield. Divided by dividend yield, you can say dividend yield minus the growth rate, okay, minus the growth rate. I can rewrite this to say DO into 1 plus G divided by dividend yield. Our dividend yield can be R. I can denote it as R minus G. All right. So this is the formula you can also use for calculating the growth rate. All right. So now that is for that. Any of these two formula can be used to determine the value of the business using dividend yield. So let's move to the next one, which is any yield. We still have discounted cash flow method. So within the next 45 minutes, we should be done. We should be done with our explanation of the principles. Emmanuel, are you still ready with your question, or you don't want to ask the question again? Okay. So let's go for the third one, which is any yield. Earnings yield basis. The earnings yield is the same, is similar to dividend yield. The only difference is just that instead of using dividend, you are going to use earning. And remember what I told you, earnings is the same thing as profit after tax. Earnings yield is the ratio of earnings to share price. Is the ratios of earnings to ratio of earnings to share price. Okay. The valuation using any yields is calculated as the present value of future earnings discounted at the rates of return of the company at the rate of return of the company's shares. Okay. Now, how do you then calculate? There's a mark on my screen. Let me stop sharing and reshare again so that the mark can disappear. Okay, then it's gone. So, how do you then calculate the value of a business using earnings yield? Again, there are two ways you can calculate the value of a business using earnings yield. If earnings are constant, where earnings is constant, then valuation will be equal to earnings divided by the rate of return. Rate of return, R. Okay. So, but where earnings are growing, where there is growth, then valuation using earnings will be calculated as earnings multiplied by 1 plus growth rates. Please, again, I don't know. This is not connecting. Okay, it's back. So where there is growth, so earnings multiplied by 1 plus G. Let me write it out in full. Multiplied by 1 plus G divided by the rate of return. Or you can say E multiplied by 1 plus G, rate of return minus G. So divided by R minus G. So that's that. So you remember when we had, let me use this one. You remember when we had cost of equity, we said that using dividend yield, cost of equity where there is growth. We said that cost of equity where there is growth, we have KE, which is equal to the current dividend multiplied by 1 plus G divided by XDIV share price. You remember, XDIV share price, simply put share price. Then plus the growth multiplied by 100%. You remember this formula? Yeah. So it's the same thing you are going to use to calculate your market value. Therefore, all you need to do is to just cross multiply. The share price is the value that you want to determine. So the KE, which is the rate of return or dividend yield, will then become the denominator. So the G you have here, instead of plus G, it will now be minus G. That's why you are seeing the formula like this. Okay? So we have to get the value. This is the formula you are supposed to use. The same thing applies to the earnings yield, using earnings yield. So of course, this is EO. This is the latest earnings. It's what you want to grow to the future. All right. So that's the same thing here. Now that's that. We have explained. We have discussed the three categories under income-based approach. We talk about price earning ratio. We talked about dividend yield. We also talked about earnings yield. So the last one we want to talk about is discounted cash flow method, which is the most technical, the most sophisticated method of valuation. So this will take time. Gloria, go ahead with your question.
Yes, sir. My question, that rate of return, how do you get rate of return?
Your rate of return is your cost of equity.
Cost of equity, not cost of, okay, cost of equity, not cost of capital.
Not cost of capital.
Means
All right. Okay. All right, then. So let's talk about discounted cash flow method. Discounted cash flow method. That's the third one. Third method of valuation. Number C, discounted cash flow based approach. Okay, discounted cash flow based approach. Like I said, this is more technical relative to assets and income-based approach. So just pay attention and then follow as we are discussing it. Now, the discounted cash flow based approach represents or relies heavily on the use of cash flow to valuing a business. Let me just put it down. This is a method of valuation. This is a method of valuation that relies heavily on the use of free cash flow in determining the worth of a business or of a company's share. Under this method, there are three scenarios that may occur. Before we go to the scenarios, let's talk about how to estimate free cash flow. Now, as far as discounted cash flow basis are concerned, you are going to need, of all the valuations the calculations that you are going to do under the discounted cash flow basis, over 90% of a situation, you are going to calculate free cash flow. Therefore, you must understand how to calculate free cash flow to the firm, free cash flow to equity. So once you understand how to do that, the remaining one is simple, because after you have determined the free cash flow, you need to apply the scenario as given in the question. There are three different scenarios that may occur in relation to acquisition. So all of them, they have different methods or different approaches. So when we get there, I will explain to you. But for now, let me demonstrate for you how to calculate free cash flow. Because when you want to evaluate a business using discounted cash flow basis, your starting point is to calculate free cash flow. Your starting point is to calculate free cash flow. Therefore, how do you then calculate the free cash flow? Let's start from there. After the free cash flow, then we need to talk about the scenarios that could play out when there is acquisition of businesses. All right, so let's take it one by one. Calculating free cash flow. Now, okay, calculating free cash flow. So what is free cash flow? Free cash flow is the cash flow available for distribution. Free cash flow is the cash flow available for distribution to the providers of capital. To the providers of capital after considering all relevant outgoings. That is, after making relevant payments. Okay, you want to pay salary, you have paid the salary, you have paid tax. Okay, you have capital expenditure that you want to incur, like non-current assets, you have accounted for all of that. Then the balance you have left represent free cash flow, because the cash flow is available for distribution to the providers of capital, okay, to providers of funds. Therefore, how do you then calculate the free cash flow? So there are two types. It could be free cash flow to the firm or free cash flow to equity. The free cash flow to the firm is the cash flow available for distribution to the providers of capitals, like ordinary shareholders and the debt holders. But the free cash flow to equity is the cash flow available for distribution to equity holders only. So there is difference between the two. So this space will not contain. Let me go to the next one. So I would then say free cash flow to the firm. I want to give you the format of calculating free cash flow to the firm. Free cash flow to the firm or to the company. So remember, when you say free cash flow to the firm, what you want to calculate is meant for two categories of providers of capital: one, equity holder and debt holders. So what this simply means is that the returns attributable to those categories of investors will be ignored. There's nothing like dividend. There's nothing like interest expense. Anything that has to do with those providers of capital, you ignore it in your calculation of free cash flow to the firm. Therefore, when you want to calculate free cash flow to the firm, you are starting from, it depends on where you want to start from. If you want to start from profit before interest and tax, so you go to the income statement as given to you, you pick profit before interest and tax, PBIT, whatever the profit before interest and tax.
I have a question.
Please go ahead.
All right. So you said free cash flow to the firm is the cash flow available for distribution to ordinary shareholders.
To providers of capital.
Okay, to providers of capital.
Yes.
The two.
The ordinary shareholders and the debt holders.
Okay, sir. All right. Thank you, sir.
You're welcome. Okay. So you go to the income statement, you go and pick the profit before interest and tax. Whatever it is, come and post. The next thing that should follow, ordinarily, after profit before interest and tax, you're supposed to pay the interest expense, but you ignore, because the free cash flow that you want to calculate is meant for the debt holders as well. Therefore, you are not going to consider interest. So the next thing will be tax. You need to pay tax. Tax will be paid, you multiply the company tax rates. So tax is calculated as profit before interest and tax multiplied by company tax rates. Okay, so you come and post, be less. There is no need for you to find the difference. The next thing you need to do, before you arrive at your profit before interest and tax, you have deducted the depreciation. Depreciation is a non-cash item. What you are looking for is cash flow. So depreciation is not a cash flow. Therefore, you need to add back depreciation that you have deducted before you arrive at your PBIT. So you add back non-cash item like depreciation or amortization. So you add it back. Then after this, you need to consider changes in working capital. Changes in working capital. So you need to watch out. In the changes in working capital, you know that working capital is different between current asset and current liability. In most cases, if examiner wants you to calculate for working capital, examiner will not give to you working capital directly. So the balance sheet information will be given to you. So you have responsibility to be able to know that, okay, working capital is different between current asset and current liability. So you go into the question. If you are given in a question, if you are given 2 periods, balance sheet for 2 periods, for 2 different years, it means that examiner wants you to watch out for movements in the current assets. Say, for example, you are given a balance sheet for 2020, you are also given a balance sheet for 2021. Then you now go to the current assets for inventory. What is the value of inventory in 2020? What's the value of inventory in 2021? If there's a movement, if there's a change, then that change is what you are going to consider. You do the same thing for account receivables. For your debtors, in 2020, how much was debtor? In 2021, how much was debtor? What is the difference? Are they equal or there's a movement? Either up and down movement, then you need to consider the change. So at the end of the day, you accumulate all the changes that have taken place. Then you sum it up. So that would be the changes in working capital. It could be an increment or a decrease. Okay, it could be a plus or a minus. If your working capital increases, that means company has spent more money. That's a cash outflow. So you put it in brackets. If your working capital has reduced, then of course it's a plus. Okay, that means cash has come in. So that's the interpretation. I believe you guys have done IS7 statement of cash flow statements. Okay, cash flow statements, you have done it. So that is how you are going to do that. Then after changes, if, like I mentioned, if the working capital increase, if the working capital increase, it's a minus. Okay. If working capital increase, it's a minus. But if working capital decrease, it's a plus. Watch out for that. When we get there, we are going to have illustration to that effect. Then after changes in working capital, you need to consider capital expenditure. Capital expenditure. You want to know if the company will incur non-current assets. If there is any, put it there. It's a minus because the company is spending money. So at the end of the day, you need to determine the free cash flow to the firm. So whatever you have here represent the free cash flow to the firm. So this is how to calculate free cash flow to the firm. The only areas that you can have challenge is the determination of your changes in working capital, especially if you are given 2 periods. If you don't know how to check for the movement, then it may pose a trouble for you. But when we have live question, I believe you will understand better. So this is the format for calculating free cash flow to the firm. Let's talk about free cash flow to equity. Now, what if I don't want to calculate, what if I'm not given profit before interest and tax? What if I'm given profit after tax? What am I supposed to do? If I'm given profit after tax, I don't have profit before interest and tax in the question, but I'm given profit after tax, and I want to calculate free cash flow to the firm. How can I do it? So let me show you another way of doing that. Free cash flow. Yes, Elena.
I wanted you to recap on the changes in working capital. I didn't get the part where you were saying if this is a decrease or increase. I didn't get that part, please. Sorry.
I said if your working capital increases, it will be a minus. That means cash has gone out. But if your working capital reduces, that's mean your cash has come in. So if cash has gone out, you put it in brackets. If cash has come in, sorry, I didn't put this one in brackets. So if cash has come in, you put it, it's a plus. But if cash has gone out, you put it in brackets. That's what I said in the changes in working capital. So you compare. If you are given 2 periods for that matter, for example, 2022, 2023, what is the inventory in 2022? What are the inventory in 2023? If there's a change, you consider the change. The change could be increments, or it could be an increase or decrease. So look for change in account payable, in account receivable as well. So is it an increase or a decrease? So if it's an increase, you put it in bracket, it's a cash outflow. But if it's an increase, it's a cash inflow. Sorry, if it decrease, it's a cash inflow. All right, Elena?
Yes, it's fine. Thank you.
All right. So another way of calculating the free cash flow to the firm is what I want to show you. Free cash flow to the firm. This one is starting from, we want to start from profits after tax. If in the question examiner, if you are not given, if you are in the question, you are not given profit before interest and tax, but you can see profit after tax in the question. So you want to start from profit after tax. So I will pick the profit after tax, put it there. Before the company arrives, before you arrive at profit after tax, you might have deducted interest expense. You have paid tax. You have deducted all relevant expenses. Then, since what you are calculating, the free cash flow to the firm that you want to calculate belongs to both equity holder and debt holders. Therefore, you need to deduct because in this profit after tax, interest expense has been deducted. So you need to add back the interest expense. I would then say net interest expense, so which is calculated as interest multiplied by 1 minus tax rates. Okay, interest multiplied. Say for example, tax rate is 30%. The interest expense is 500. Interest expense is 500. Therefore, the net interest is what I'm going to consider. I will just say 1 minus tax. Okay, 1 minus tax multiplied by 500. So whatever it is, I will come and post. You are adding it back. You are adding it back because the free cash flow to the firm that you want to calculate belongs to both equity holder and debt holder. So that is, you only do this if you are starting from profit after tax. But if you are starting from profit before interest and tax, you don't consider all of this at all. Yes, Prosper. Go ahead.
Okay, sir, please, my question is, why are we multiplying tax on interest? I thought interest is tax exempted.
Why are you multiplying tax on it? Before you arrive at profit after tax, I told you you've already charged your interest. So you need to consider remember, there is tax savings, isn't it, in relation to there's tax deductibility in relation to debt. Are we together?
Yes, sir.
So it's just a format that you have to adopt. It's just a concept when you are calculating your free cash flow to the firm, whereby you are starting from profit after tax. So the net interest is what you are going to consider. That's what I said, net interest. You can see I did not put interest expense, net interest. And you know, anything that has to do with net, you have to consider 1 minus tax, isn't it? So you are adding it back. Now, after this.
No, sir. Sorry, sir, for bringing you back.
Yes. Go ahead.
Still regarding to what she said concerning the interest. If you are giving the gross interest, I will still go into a net of
there is nothing like gross interest. Interest is interest. Just calculate your net interest and move on. Nothing like gross interest in the question. Okay? There's nothing like net interest. Just go ahead. It's just a format that you have to follow. Nothing like gross interest. So once you are given in the question, the income statement given to you cannot see profit before interest and tax. That's my explanation. You are not given profit before interest and tax. So in that case, you are only given profit after tax and other information. So that means you want to calculate free cash flow to the frame. What are you supposed to do? So you are starting from profit after tax. So before you arrive at this profit after tax, you have deducted interest expense. I'm now saying that, okay, the next thing you are going to do immediately after the profit after tax is to consider net interest. How do you calculate your net interest? Is to adjust for 1 minus tax. That's all. Just pick the interest expense, minus multiply with 1 minus tax. That's what you need to do. Is it clear, Ifeanyi?
Yes, sir.
All right. So Gloria, what again? Talk to me. Yes.
Is that capital expenditure? Why are you, when the first format, why are you why you are deducting it?
You say you yourself just mentioned, you say capital expenditure. You are spending money. When you are spending money, your cash is going out. You have to put it in brackets. Is it clear, Gloria? Hello?
Yes, sir.
So it's an expenditure. You are spending. So because what we want to do is cash flow. You want to know cash that has come in and the cash that has gone out. Then whatever you have available thereafter is what that will be distributed to the providers of capital. So your capital expenditure, say for example, you want to purchase non-current asset like motor vehicle. When you want to buy motor vehicle, what will happen to your cash flow? Your cash flow will go out, isn't it? So you have to put it in brackets. So it's a cash outflow. Capital expenditure is a cash outflow. Is it clear, Gloria? All right. Move on.
Yes, sir.
Okay. So immediately after the net interest, you don't consider tax again because before you arrive at your profit after tax, you've already paid tax. The next thing you need to do is to add back non-cash item like depreciation. I would then say depreciation because before you arrive at the PAT, you've already deducted depreciation or amortization. So you add it back. Not only that, you also need to consider changes in working capital. Changes in working capital. Decrease or increase. Then you consider capital expenditure. So it's a cash outflow. Then at the end of the day, you have your free cash flow to the firm. So this is another way of calculating your free cash flow to the firm. So I've shown you two different ways of doing it. So if examiner if you are given profit before interest and tax, you use this first format. But if you are given profit after tax, you are not given profit before interest and tax, but you are given profit after tax, then you use the second format. So whichever one, you have to master the two. So whichever one that comes out is the one you are going to use. Okay? So that is for that. So let's move to calculating free cash flow to equity. Let me go to the next page. Okay, let me start from here. Free cash flow to equity.
Wait, I want to copy the formula.
Don't worry, I'm going to share with you. Just don't worry. All right?
Yes, sir.
So calculating free cash flow. Let me write it out in full.
Sir, please jacket the capital expenditure.
Pardon? Oh, okay. Thank you. Free cash flow to equity. So like I explained earlier today, the free cash flow to equity is the cash flow available for distribution to providers of equity capital, the cash flow that will be distributed to ordinary shareholders. Therefore, how do you then calculate the free cash flow to equity? If in the question, I'm going to give to you maybe 2 or 3 different formats, whatever the way the question is being designed. So whichever one, you'll be able to do well with it. Now, if in the question, you are given a scenario and you're asked to calculate free cash flow to the firm, then number B, you are asked to calculate free cash flow to equity. Then in that case, of course, we are starting from free cash flow to the firm. So whatever you have done here in this particular one, you come and put it, that's the free cash flow to the firm. Remember, we said that free cash flow to the firm is the cash flow available for distribution to the providers of capital. So from the free cash flow to the firm, the first category of providers of funds is debt holders. So you need to first of all settle the debt holders. So the balance you have thereafter will now be for the equity holders. So from this free cash flow to the firm, I need to pay interest expense. I will then come here, interest expense. Okay, I will less, because the debt holders, they're entitled to receive their interest. So you pay. Then after that, you need to consider loan repayments. You need to consider loan repayments, loan/debt repayments. Part of the loan that you have borrowed, part of the loan that the company has borrowed will need to be repaid. So when you pay part of that loan, your cash is going out. So you have to put it in bracket as well. It's a cash outflow. Not only that, it is also possible the company may also receive proceeds from the debt issued. The company might have issued debt to other investors or to other companies, and those companies are now paying back. They are repaying the debt. In this case, that would be proceed from debt issue. It's a cash inflow. So you consider proceed from debt issued. So it's a cash inflow. So at the end of the day, you are going to have your free cash flow to equity. Free cash flow to equity. So this is one way of calculating free cash flow to equity. This method is better where you are asked previously to calculate free cash flow to the firm. So in that case, within 2 minutes, you are done with your calculation. No adjustment is needed in this area because you've already done any adjustment that you want to make in the calculation of the free cash flow to the firm. Please, sir, is the cap expenditure not supposed to be in the bracket? Yes. Thank you, Okesade. I've just done that. All right then. So now this is one way of calculating free cash flow to equity. What if you want to calculate free cash flow to the equity from the beginning? Examiner gives to you a scenario. You now have to calculate free cash flow to equity. Therefore, free cash flow to equity. In this case, starting from, if you want to start from profit before interest and tax, starting from profits before interest and tax. So how do you then calculate this? So I will say PBIT. I will less interest expense. Interest expense. In this case, there is no need for adjustments. You are not calculating net interest. So interest expense After your net interest, of course, you are going to have profit before interest and tax. Profit before tax. So you charge your tax. So you charge your tax will be equal to profit before tax multiplied by company tax rates. Okay, less. Then after that, if you like, you can find if you can find the difference or just move on from here. Okay, I will then say I will add back non-cash item. Depreciation, amortization. You add it back. Then you consider changes in working capital. Decrease or increase. Then you consider capital expenditure. Cash outflow. You consider loans or debt repayments. When you repay loan, the cash is going out. Then you consider proceed from debt issued. There is a cash inflow. Okay, at the end of the day, you have your free cash flow to equity. So this is another way of calculating free cash flow to equity, especially if you are starting from profit before interest and tax. In the question, you are not given profit after tax. So you are only given profit before interest and tax and other information. So in this case, this is the format you are supposed to follow. Praise, talk to me.
Yes, sir. So I can do the free cash flow for equity without having to go through calculating free cash flow to the firm first
Take your
and then
question.
adjust it.
Take your question again.
I'm saying that I can go through this format straight without calculating free cash flow to the firm first and
Yes.
then adjust with
Yeah.
settlement to debt holder.
Yeah, so that's essence of this format. Because it is possible in a question that examiner may ask you to just calculate free cash flow to equity, not free cash flow to the firm in this case. You are just asked to calculate free cash flow to the firm, sorry, to equity. So in this case, and then in calculating the free cash flow to equity, you are not given profit after tax. If you are given profit after tax, that will be faster. But if in case you are not given profit after tax, you are only given earning before interest and tax. So this is the format you are going to apply. This is the format you are going to apply. But if in the question, you are asked to calculate free cash flow to the firm, and you have done that before, then you cannot use this one. It's better for you to use the shorter one, which is the first one I did. This one, to calculate the free cash flow to equity. Now, the last method, the last format of calculating free cash flow to equity would be if in the question you are given profit after tax. Please, if in the question you are seeing you are given profit before interest and tax, you are also given profit after tax, and you are now asked to calculate free cash flow to equity. Please don't use this one. Don't use this second one. Rather use the third one that I want to give to you now because it is faster. A0, talk to me. A0, you raise hand. A0. Okay, you are not ready.
Can you hear me?
Go ahead. I can hear you.
Okay. For the tax,
Yes.
What I'm saying here is based on the accounting profits. Will there not be an adjustment based on the actual tax paid?
You are looking at you are using, this is finance. You are using corporate reporting accounting purposes or adjustments. That one does not apply here. Okay.
Okay.
It doesn't apply here. That one applying in reporting, not in finance. All right?
Okay, okay,
Yep.
okay, thank you. Yeah.
So the third one, free cash flow to equity. If you want to start from starting from profits after tax. You want to starting from profits after tax. So with this, what are you supposed to do? Simple. You pick your profit after tax. In this case, interest expense has been deducted. Tax has also been deducted. Therefore, after your profit after tax, you add back the non-cash item like depreciation, amortization, add it back. You consider changes in working capital. Then you consider capital expenditure. Cash outflow. You consider loan repayments because before you arrive at propriety, you have not considered loan repayments. So you consider loan repayments, loan or debt repayments. So it's a cash outflow. Then you consider proceed from debt issue. So this is a cash inflow. Then with this, you determine your free cash flow to the firm, to the equity. So I've given you 5 different formats that you can use to calculate free cash flow to the firm and free cash flow to equity. 2 different formats for calculating free cash flow to the firm, then 3 different formats for calculating free cash flow to equity. Please go ahead and master each of them. However examiner tweak the question, you should be able to come out in the right way. So that is for that. Now, let me pause a little bit. Then we need to consider, after this, I need to explain to you what are the scenarios that may play out. I'm coming, Mr. Gabe. What are the scenarios that may play out in acquisition? We have scenario 1, we have scenario 2, we have scenario 3. Once I'm done with the explanation of the scenarios, they will now begin illustrations. So let's take it one after the other. So Mr. Gabe, talk to me.
So please scroll down.
Mr.
Yes, sir.
Gabe,
May I go on?
go ahead, please.
Yes, sir. Okay. In the 3 formulas given, sir,
Format.
the last one, the last one that has to do with free cash flow to equity, just
Yep.
the very last formula.
Yep.
Okay. Do you say that it is for a situation whereby you are giving both profit before interest and tax and profit after tax?
Yes.
I just want to understand that one.
Yes.
Okay.
You will see that if you start from profit after tax, what you are going to do is shorter relative to if you are given profit. If you are starting from profit before interest and tax, you can see this particular one, this format is longer. Yes. It's longer than this one. It's longer than this one. So if in the question you are given profit after tax alone, then don't need to worry yourself. Just do this one. If you are given both profit before interest and tax and profit after tax, just start with profit after tax and use this particular format. But you only use this first one, you consider this one. If in the question you are not given profit after tax at all.
Okay.
So if you are not given profit after tax, then just use your profit before interest and tax to get your free cash flow to equity.
All right, sir. Thank you very much.
You're welcome.
Yes, sir.
Okay, so we have spent about 2 hours. Let's take a short break. Let me see.
Scroll down.
Okay. Or before we take a break, let me explain the scenarios. This scenarios is big. Let's take a break. Let's take a break. All right. So let's take a break for about 15 minutes. So let's rejig ourselves, put something in the mouth, then relax, then continue. Okay? Oh, okay, Mr. Gabe, go ahead. You want to ask a question again?
Not at all, sir. I'm done. So sorry, so sorry. I'll cancel
Okay.
it now.
Okay.
Sir, what time are we resuming back?
This is 11:06. By 11:20, we'll resume 11:20.
Okay,
Sir,
sir.
what time is this? What time is this class supposed to end?
2:00. Let's talk about the scenarios that will occur in acquisition. Let me share my screen again. Acquisition scenarios. Now, when there's business combination, there are different ways in which the valuation can be carried out. Depending on the scenario that plays out, it is possible when there's business combination, and then it can be determined that business and financial risk will change. Okay, let's do it this way. Scenario 1, because of time, scenario 1. Under the scenario 1, this is a situation whereby, or this occurs where the business and financial risk are expected to change as a result of business combination. So, if it can be ascertained in the scenario in the question that business and financial risk will change as a result of the business combination, then the free cash flow should be discounted using work of the combined activities, using work of the combined businesses. Where in this situation, the free cash flow should be discounted using the work of the combined businesses. That is work of the combined businesses. The same way you calculate the same way you calculate WACOCA is the same way you are going to calculate WACOB. But the only difference is just the fact that instead of identify proxy beta, you are going to identify the beta of each businesses. Okay, so under this situation, your first step is to calculate free cash flow.
Sir, excuse me, sir, please.
Yes.
Sir, what do you say is the difference between this work and the work of a combined business?
I said it's the same thing, only that Under Wakoka, you identify proxy beta. In this one, you only identify the beta of individual business. So procedures. Step 1, when you want to calculate the value of a business, in this scenario 1, where business and financial risks are expected to change. So step 1 is to calculate free cash flow. Free cash flow to the firm, as we have done above in those formats. You calculate free cash flow to the firm. Then step 2, calculate work of the combined businesses. How do you calculate the work of combined businesses? Let me remind you, to get the work of the combined businesses, step 1 is to identify the beta. Identify the beta of each businesses instead of identifying the beta of each activity. So you are going to identify the beta of each businesses of each company. So let's say, for example, company A and company B, or company A wants to acquire company B, or company A wants to merge with company B, and you have discovered that after the merger, business risk will change, financial risk will also change. So as a result of that, then you are going to calculate free cash flow to the firm. Then you calculate workup. So your workup, in calculating your workup, I will go to the question. What is the beta of company A? What's the beta of company B? That will be in my step 1. Then step 2 is for me to ungear the beta if geared. The beta will be geared if the companies have debt in their capital structure. So I will ungear the beta. Then step 3. The only difference is that in this step 3, of course, you are going to calculate market value of equity and debt, same procedure. So you calculate market value. Market value of equity and debt of each company. That is pre-merger or pre-acquisition market value. Pre-merger, this is called pre-merger or pre-acquisition market value. Okay. Then step 4, you calculate beta asset of the combined. Calculate beta assets of the combined. You already know this one, the beta asset of the combined. So I don't need to write out formula for you again. So step 5, you regear to incorporate financial risk. Step 6, you calculate cost of equity using capping. Then step 7, you calculate workup. So these are the procedures you are going to carry out whenever you want to calculate workup. Now, that's step 3. Then step 3 here is to calculate the present value, calculate post acquisition or post merger, calculate post merger or post-acquisition market value. This can be calculated. This can be calculated by multiplying the discount factor or by calculating the present value. By calculating the present value or multiplying step 1 with step 2 by multiplying step 1 with step 2. Step 2, using the discount factor. You all know, you know how to calculate present value. So just multiply the discount factor with the free cash flow. That's that. Then step 4. Step 4, you calculate debt value. You calculate equity value. Since now that you have the post-acquisition value, the next thing you need to do is to calculate equity value. Calculate equity value after the merger or acquisition. In this case, the equity value will be the difference between post-merger value and pre-merger value of the combined businesses. This represents the difference between post-merger value and pre-merger value of the combined entities. So that will give me, sorry, what am I saying? The difference between post-merger value and debt value. And debt value. As shown below. Okay. So to get the equity value, I want to calculate equity value. I will pick the post-merger value. Because this post-merger value is meant for both equity holders and debt holders. Therefore, from the post-merger value, I need to first of all give the debt holders their own contribution. So debt value will be the post-merger value multiplied by the percentage of debts. Okay, the percentage of debts. It may well be that debt equity ratio after the merger or after the acquisition may be 40 to 60 or 50 to 50 or 30 to 70 or 20 to 80, whatever the debt equity ratio, just multiply with the post-merger value. So that will give the value for the debts. So once you get the value of the debt, the difference will be the value of equity value. Okay? So this is what you are going to do in scenario 1. In scenario 1, this is what you are going to do. Let's move to scenario 2. Jude, you say you are lost. Somebody is saying you should find yourself. Elijah, see your mouth. Find yourself. Okay. What's this step is listing? You are just talking. You should have raised your hand now. Bibli, talk to me.
No, I didn't want to interrupt.
It's okay. So raise your question. What's your question? What's your concern, Jude?
After rejoining, I just met this you talking about scenario one. So I don't know.
Don't worry. When you listen to the video, what do you want to know? Scenario one. Because you came late now, you know we can't go back again. So we said we are going to meet again at 11:20. So just take your time. You will recollect. All right. BB. Yes, BB.
Yes, sir. So I was just asked what is the PMV that you said PMV times.
Post-merger value.
Yes, they are both.
Post-merger value.
Okay, sir. Okay, sir. Thank you.
PMV means post-merger value. Okay. So let's go to scenario 2. In this scenario 2, this arises. Scenario 2 arises when business risk will not change, but financial risk will change as a result of the business combination. So when this happens, the combined business should be valued using adjusted present value. The valuation should be done using adjusted present value. For all of you that are running away from APV, now you have it again. That's what I took my time to explain to you. Under APV, you are blinking. Okay, Jude, continue to blink. Don't worry, you'll be fine. Seriously, you'll be fine. Just take your time, get what we're trying to communicate. You pick up in between. Okay, so under scenario 2, business risk will not change, but financial risk will change as a result of the business combination. So when this happens, the valuation should be done or should be carried out using adjusted present value. All the procedures you know in adjusted present value will apply. All right. You know, under adjusted present value, there are 4 different procedures. Let me just give to you step 1 or steps. Step number 1, what are you supposed to do? You calculate free cash flow. Because business risk is not changing, but financial risk will change. So we are using APV. So in this case, step 1, you calculate free cash flow. Free cash flow. Then step 2, you calculate base case NPV. Of course, okay, let me rewrite this. Calculates, the first one is to calculate base case NPV. Calculates base case NPV. In calculating the base case NPV, what are you supposed to do? You calculate free cash flow. Calculate free cash flow. Then step 2, calculate cost of equity on gear. Calculate cost of equity on gear. You know how to calculate cost of equity on gear. If you are given beta how do you calculate it? If you are given cost of equity, how do you calculate it? If you are given WACC, how do you calculate your cost of equity on gear? We have done this extensively under adjusted present value. Then step 3 rather, you calculate total present value, estimates total present value. The total present value is just you multiplying the free cash flow with the cost of equity on gear. This can factor of the cost of equity on gear. So to get your total present value. Once you have your total present value, the less you calculate your base case NPV. So calculate base case NPV. To get your base case NPV, you are going to deduct the total present value. This is total present value. This is the total present value minus the purchase consideration, minus purchase consideration. Okay, that will give you the total, that will give you the base case NPV. You keep it on one side. Once you get your base case NPV, keep it on one side. Move to step 2. Step 2 says calculate present value of financing effects.
Hello, sir, please. What's calculate KFU?
Not
Like
KFU.
KEU.
KEU, cost of equity on geared.
Okay.
Cost of equity on geared. KEU. All right. Now, step 2, calculate PV of financing effect cash flow. So you know how to calculate PV of financing effects. You go ahead and calculate PV of issue costs, calculate PV of net subsidy, calculate PV of tax saved on interest, if they are in the question. If not, whichever out of the 3, whichever one that is there is what you are going to calculate for. So once you have your PV of financing effects, then step 3 is to calculate the APV. So calculate adjusted present value, which is the adjusted present value is the same thing as corporate value. So that is the post-acquisition or post-merger market value. Okay, that represents the post-acquisition market value. So step 4, you need to calculate equity value. All right. For you to get your APV, so you know base case NPV minus present value of financing. Okay, this is APV. Let me write that. APV equal to base case NPV plus minus PV of financing effects. Then step 4. So we need to calculate equity value. This corporate value represents the post-merger value. This particular one represents post-merger value. That is the value of the combined businesses after the acquisition or after the merger. Then step 4, you calculate equity value. Because as a company, you need to know how much will be attributed, how much of the value will be attributable to the equity holders. Calculate equity value. So to get the equity value is calculated as the APV, the adjusted present value, which is what I call corporate value, or post-merger or post-acquisition market value. You put it there, then you less the debt value. The debt value is the proportion of debts multiplied by the corporate value, because the corporate value is the total value made for both equity holders and debt holders. So the debt holder must be paid first. So you pick the percentage, your APV multiplied by the proportion of debts. Okay? So you less, whatever you have thereafter represent the amount attributable to equity. So this is what you need to do under scenario 2. For scenario 3, the scenario 3 will occur. This occurs where business and financial risk will not change. This is the most straightforward of all the scenarios. So the business and financial risk will remain constant, will not change. As a result, valuation should be determined using the current WACC of the combined. So discount.
So please, can you just go up a bit so I can see the top? Sorry.
So you want me to leave the word I'm writing to go up?
No, you can just adjust it a bit, like to fit the
Once
screen.
I'm done, I will do just that.
All right, thank you.
WACC of the combined to discount the free cash flow. So what this simply means is that if in the question, the business risk and financial risk are not expected. Is it this one you are talking about? Hello? You say I should move up. Is it this one?
Yes,
Okay.
yes, it is.
So under the scenario 3, business and financial risks remain constant. They are not changing. So as a result, the first thing you are going to do is to calculate your free cash flow. Once you are done calculating the free cash flow, then you calculate the current WACC. The current WACC will be the WACC of the combined business after the acquisition or after the merger. Okay? So that would the normal way you calculate your weighted average cost of capital is, so that's what we are saying here. So your free cash flow should be discounted using the current WACC, because business and financial risk are not changing. Okay, so let me just procedure steps. Number 1, calculate free cash flow. Step 2, calculate weighted average cost of capital. Step 3, estimates the post-merger. Let's restrict to merger. Merger and acquisition are used interchangeably. So estimates post-merger market value. The post-merger market value represents, is calculated by multiplying the free cash flow, by discounting the free cash flow with the current WACC. This is calculated by discounting the free cash flow with the current WACC. That's that. Then step 4, if you are now asked to calculate equity value, you are asked to calculate equity value. Calculate equity value. So the equity value is the difference. This is the difference between the post-merger value and the debt value. Okay, that's that. So I've explained all the principles. The last thing I need to talk about is maximum price to pay. This is also very common, especially when there is...
No, sir, we are still writing. No, please scroll down.
Let me complete what I'm doing first. Okay, I will show you. Like I said to you, I'm going to share the document with you. But for now, let's just maintain. So let me, so that I don't
Sir,
forget.
please, so that we can be following you.
Maximum price to
Yes,
pay.
so we can be following you.
Where are you following me to? Are you
Yes,
following?
now.
Where are
To
you
anywhere you
following
want
me
to
Go
to?
go.
down.
I'm writing now.
Sir,
I'm
please,
writing.
we
Say I
need
should
this,
be.
please.
Uh-uh.
We are
My God.
following you today.
So what do you? Well, okay.
Just a little,
Well,
let's snap it, please. I
no,
beg.
you don't need to bother yours. I say I will share this particular document. Immediately I'm done. I'm going to share everything with you. Why are you stressing yourself?
No
Sir,
time to go
sir,
back
that would be
to
a long stress on our part.
Okay, oh
Yes,
yeah.
now
Oh,
we'll not be
That
looking
would be
for
a
it
long
and
stress.
writing.
okay, what do you want me to do
So
now?
it's not
Marina.
about it, so that in case you are doing calculations,
What do
so we
you want
can
me
be
to
following. That's why
do?
we need particular step.
Is
What
it
you've
the
just done
And
now,
then leave
sir.
it so we can
okay?
put it
Okay, I'm waiting for you. You have 1
We are
minute.
done.
Okay, you are done.
Better.
Mm.
Better.
No,
If
you are
are you
done. Speak
done?
for yourself.
If are you done?
I'm not done. A minute.
Are you copying or you
Snap,
want to snap?
snap it and let's
I'm
go.
snapping.
I beg.
Okay, snap.
Are you done snapping? If I
Yes.
okay then. So now the last area I need to talk about is the maximum price to pay. Maximum price to pay. Now, when there is merger, examiner may want you to determine maximum price that the acquiring firm will pay to the acquired or the target entity. Therefore, the maximum price to pay represents the maximum price to pay represents the difference between post-merger value and pre-merger value of the acquiring company, The acquiring company is the predator, is the initiator, is the one that initiates the transaction. All right. So when you have to calculate maximum price to pay, you need to calculate, for you to get the maximum price to pay, the first thing you need to do is to calculate pre-merger value. That is the market value of the two companies, the acquiring company and the target company. So you calculate their market value before the merger. Then you also need to calculate market value after the merger. The market value after the merger will represent the market value of the two combined businesses. Then, of course, step 3 is for you to calculate the maximum price to pay. So the maximum price to pay will be the difference between the post-merger value and pre-merger value of the acquiring entity. So examiner can ask you. So that's why I have to chip in that one. I think at this point, we have
Sir,
covered.
hello, sir.
Who is
Hello, sir.
speaking?
Please, can you keep quick, Elijah?
Okay.
Please, can you quickly recap what you just said as regarding pre-merger value and post-merger value? I was writing like the market value of pre-merger value is. You were fast there.
What do you mean I've said this more than 3 times. Say I
Sorry,
was
sir.
fast. I said maximum price to pay represent the difference. It's even written on the screen. Represent the difference between the post-merger value and pre-merger value of the predator. The predator is the acquiring firm, is the company that initiates the transaction. So in case you are asked to calculate maximum price to pay, you need to calculate first thing first. You need to calculate the pre-merger value. What is the pre-merger market value of the acquiring and the target company? You calculate the 2 of them separately, keep it on one side. Then you now go ahead and calculate the post-merger market value. The post-merger market value is the market value after the merger. So the difference between that post-merger market value and the market value and the pre-merger market value of the acquiring firm will represent the maximum price to pay. So Elijah, are you okay?
Market value.
So who is the target company?
Who is speaking? Yes.
Praise.
Praise. Now.
The target.
Okay, this is it. Praise. Let's demonstrate a scenario. This is Adejuwan. This is Praise. We have calculated. Adejuwan is saying that he wants to acquire Praise. Adejuwan wants to acquire or want to merge with Praise. Adejuwan wants to merge with Praise. As a result, as of today, I need to calculate the market value of Adejuwan. I need to calculate the market value of Praise. This represents pre-merger value, the pre-merger market value. Okay, this represents the pre-merger market value of Adejuwan and then the one of Praise before the merger. Now, I want to know what is the market value of the combined of AP. AP is Adejuwan plus Praise. So what will be the value after the merger? So that represents the post-merger value. Therefore, I need to calculate post-merger market value of AP. It's no more A separate, P separate. So I want to calculate the market value of AP. AP is the combined entities. So as a result, if you are now asked to determine the maximum price to pay, I would then say maximum price to pay would then be equal to the post-merger value of AP, market value of AP, that's after the merger, minus pre-merger value of A. Pre-merger value of A. So that will give me the maximum price to pay. That's why we are saying that the maximum price to pay represents the difference between the post-merger market value and the pre-merger value of the predator. The predator is the acquiring firm. So in this case, Adejuwan is the one that is acquiring or merging with Praise. All right. So as a result, so when I want to, how much price am I going to pay to Praise? What is additional, what is the maximum price I'm going to pay to Praise? The additional price Praise will receive will represent the difference between the post-merger value and the pre-merger value of Adejuwan in this case. Praise, is it clear to you now?
Please, can you recap this? I don't understand this.
Those of you just want to stress me unnecessarily. Abi, I know, no worry.
Sorry, sir.
Because you know that if we are in the class, basically, no worries. No worry. Elena, you say I should recap. If I hold on.
Yes.
You want me
I
to
don't
recap?
understand.
Which one you don't understand?
That's this explanation, the example that you just gave now.
Okay.
Hi.
Yes, who is talking? Who is talking again? Okay. Let me just mute. Yes, this is what I'm saying, Elena. Maximum price to pay. Okay, let me use another example. Say, for example, company A and B are combining to become one. Company A and B are combining to become one. As of today, the pre-merger market value of company A is 50 billion. Pre-merger market value of company B is 30. Of course, A is the company that initiates the transaction. A is the one that make that move. The person that make the move is the predator, is the acquiring firm. So the target company is the company that you want to merge with or you want to acquire. So in this case, since A is the one that is making the move, A will become the acquiring firm. The acquiring firm or acquiring company. Then B will become the target company. Target company or target firm. Now, if you are now asked to calculate maximum price to pay, you need to first of all determine the pre-merger market value. What is the, as of today, before the combination, what is the value of company A? What is the value of company B? You keep it separate. Then you go ahead and calculate post-merger market value. Post-merger market value. Say, for example, after the combination, you know, the essence of business combination is that there will be potential synergy. After the business has come together, the benefit would worth more than if each individual company is operating on their own. So what that means is that that's why we usually say in synergy, in a business combination, the synergy is seen as 2 + 2 is equal to 5. So there will be much more benefits that will accrue to that business combination. So let's say AB now, the value of AB, let me say this is AB, that's the combined entity. So the value of AB is now 100, for example. So after the business combination, the market value of the combined business is 100 million. So if you are now asked to calculate the you are asked to calculate maximum price to pay. So if you are asked to calculate maximum price to pay, I would then say maximum price to pay. We said that maximum price to pay is the difference between the post-merger market value of the combined, which is 100, and the pre-merger value of the predator, of the acquiring firm. Predator is company A, because company A is the one that initiates. So that would be 100 minus 50. So in this case, maximum price to pay is equal to 50. So the maximum price that company A will pay to company B is 50 billion. So that is what I've been explaining since. I believe this is clearer. Yes, Ifeanyi, you were saying something the other time.
No, I'm just apologizing on behalf of the
Oh,
students for stressing you.
Okay, no worry. I was just joking. All right then. So, yes, we are done with all the explanation. You can see we have spent about 3 hours just for discussing the concepts, the underlying concepts in valuation. And that's why we said that it's a very big one. And at this point, the next thing we are going to be doing going forward are calculations. So let's take it one after the other. So I will stop sharing these documents and I will move to the main notes.
Please come back, please. 1 minute. Thank you, sir.
All right, so let's go for calculations. Let's start. So you go to the material and read in details. Let's start from illustration number 1. Let's start from illustration number 1. This question, you may have a similar question like this in this diet. So it is possible you may have a similar question like this diet. So let's start from here. This has to do with banks consolidation. Okay? Yeah, I need one of you to read, please. Who will read for me or for us?
Michelin Bank PLC.
Okay, thank you, Morenike. Go ahead.
Michelin Bank PLC is a commercial bank incorporated in Nigeria in the early 80s. The head office of the bank is situated in Lagos, and it has a network of branches in all the states of the Federation. The objective of Michelin Bank PLC are maximization of shareholders' wealth and provision of efficient retail and corporate banking services to its individual and corporate customers. These have been achieved over the past years. Recently, the federal government, through the Central Bank of Nigeria, revised the minimum capital of banks. This condition was to be met by all banks 31st latest December 2005. This forced all the banks to offer to members of the public their ordinary shares for subscription. Michelin Bank PLC, in line with the directive, offered its shares to the public. However, it only succeeded in increasing its capital base substantially, although this still falls below the required amount. The only option that is open to Michelin PLC, if it wants to remain in business, is to amalgamate with another bank with good track record. The bank which comes to mind is Dunlop Bank PLC, which incidentally managed to increase its capital base to 10 billion naira. The board of Michelin PLC is considering making an offer to Dunlop Bank PLC. The offer is to make the form of merger on a share-for-share exchange basis. The new bank to be formed is to be called Tire Bank PLC. Extracts from the most recent accounts of the two banks are given below. We have the balance sheet extract. Both companies retain the same proportion of profits each year and expected to do so in the future. While Michelin Bank's dividend are expected to grow by 12%, those of Dunlop Bank are expected to grow by 4% per annum. After the merger, that is, in 1 year's time, Tire Bank PLC will retain 60% of its earnings, and post-merger dividend growth rate is expected to be 10%. The dividend of both companies have been paid. The required rate of return of the ordinary shares of Michelin Bank PLC is 15%, and that of Dunlop Bank is 12%. After merger, this will alter to 14%. Required. What is the required minimum capital for Nigerian banks under the current dispensation? 2. What is the type of integration anticipated by Michelin Bank PLC called? 3. If the merger is to take place immediately, calculate market values of the two banks before merger. 2. Maximum price Michelin Bank PLC will pay Dunlop Bank PLC.
Thank you very much, Morenike. Now, this is a question. In the A requirements, when you look at the scenario in this question, this kind of scenario usually happens whenever there is bank consolidation. Certainly, in the recent happening in the banking industry will also require business combination, because most of the minimum capital requirements from the CBN of about 500 million for commercial bank that has international operation, national banks, 200 billion, then 50 billion for regional banks. So all those capital requirements will be funded majorly if the company that, like for example, all those big banks, it's possible they may be able to finance. Okay, they may be able to raise the capital. Okay, how are they going to raise the capital? It may come through either issuing additional shares to existing shareholders, or raising through right issues, issuing new shares to different, new investors. So there are so many issues that will arise as a result of doing that. Another way that the banks can finance the capital requirement or the recapitalization is for them to merge with another bank. Say, for example, a company that cannot meet up with the requirements, with the capital requirement of 500 billion, which is a commercial bank, then what the banks need to do is to look within the industry and collaborate, okay, combine with other banks that are in similar situation, so that cannot meet up with the requirement, with total requirements, total capital required. So in that case, so there will be business combination in form of either merger or acquisition. Not only that, if there's any company that is not willing, or have not seen somebody that will acquire it, or a company that you can merge with, a bank that you can merge with, what that means is that bank will cease to exist. The bank will collapse. That will be the end of the bank, because you cannot meet up with the minimum requirements. The fact that the bank has said that, the Apex Bank has said that 500 billion is for commercial, 200 billion is for national operation, then 50 billion is for regional. That doesn't mean that, okay, another thing, if you cannot meet up with that, then you need to downgrade. You can downgrade. Downgrade, instead of you being in commercial, then you may be maybe a merchant bank. Instead of having a commercial operation, then that means you turn to what's it called? A merchant bank, whereby, or a non-interest bank, whereby your capital base is about 20 billion or 10 billion for national and the regional, or if it's a merchant bank, it's 50 billion. So all of this is what we are talking about. All right. So many options have been given to the banks on how they can raise the capital. So it is now left for you. If you know that you want to maintain your existing structure, you want to maintain your existing category. So category A is a commercial bank. So if that is the case, for example, banks like GTB, like Access Bank, like Zenith banks, those are banks. Some of the banks that have international operation, so their target is 500 billion. So if they can, any one of those international banks, or any one of those our banks that have international operation, because their risk is higher, so if they cannot raise the 500 billion minimum, then in that case they have to downgrade. What that means is that they are going to downgrade, or they merge, or they combine with other companies, with other banks in the industry, for them to be able to meet up. So that is for that. So that similar situation that happened in 2005 is going to play out this period as well. So the banks have about 2 years now, 24 months, starting effective from April 1st to the 31st of March 2026, for them to be able to meet up with the recapitalization. So enough of, a lot of activity will happen as we go into the next 2 years in the banking industry. So some of the banks currently, I think they will have about 21, is it 21 or 24 banks that are currently operating in Nigeria. So that will reduce. A new bank or new banks will also spring up. As a result of that, there are some people that they already have, they are processing their license already. And what CBN is saying is that, fine, if you want to raise your capital, this is just an additional information, because you never can tell where examiner will come out to you. So CBN is saying that for you to raise, if you want to raise when you are raising your capital, please don't dip into your retained earnings, because that your retained earnings is not realistic. The profits you have made in the previous years, you are keeping it somewhere, retained earnings, say for growth and expansion. That's the purpose of keeping your retained earnings. When you look at their balance sheet, in actual fact, the money may not be there. It's just in books, it's just in theory. That money is not, the real amount may not be there. It's not a cash flow. And that's one of the reasons why CBN is saying that, no, you have to raise the capital for existing banks, for the banks that are currently existing, operating in Nigeria. The capital should be raised through equity and the share premium, okay? Through equity and share premium. So shareholders' funds is not allowed. All those retained earnings is not allowed. It has to be through equity and share premium. But for new banks or any proposed banks, they are going to raise their capital through ordinary shares, through equity, because they can't have premium because they are new banks, they are new companies. So that's the target, and that's the requirement from the CBN. Not only that, so after the 2 years, it is expected that because there are so many reasons for the CBN to come out to say that banks should recapitalize. The last time the recapitalization was done was in 2005. That's about 20 years ago. So it's long overdue. Very long overdue. This should have been initiated some years back, not even now, but it's rather late than never, you know. So that is just the background. So there are objectives. I mean, there are advantages and disadvantages for this kind of recapitalization or consolidation, but that is not where we are going. I've already go to the article I wrote and I share with you. Just have some understanding in summary form in the information I share with you, so that you can gain something there. So let's move to solving this question. Okay, then. Yes. Examiner is asking us, what is the required minimum capital for Nigerian banks under the current dispensation? We are still using the one of 2005. We are still using the capitalization of 2005. So under the current dispensation, the minimum capital requirement is 25 billion. 25 billion. So that's the answer for that one. Okay. So another thing may play, the similar thing may play out this period, or if not this diet, it may come in the maybe after the consolidation, after the recapitalization in 2026. But for now, the minimum capital requirement is 25 billion. That answers number A. Number B, examiner is asking, what is the type of integration anticipated by Michelin Bank PLC called? Let's go back to the scenario. You are told in the question that Michelin Banks is willing, the board of Michelin Bank PLC, in the third paragraph, you are told that the board of Michelin Banks PLC is considering making an offer to Dunlop Bank PLC. So both of them are in the same industry. Therefore, when a company or when companies operating in the same industry with similar size merge together, that is called horizontal integration or horizontal merger. Okay, so to answer the number B requirements, the type of integration anticipated by Michelin is called horizontal integration. It is called horizontal integration. So when two companies operating in the same industry with different size or with similar size are merged together, that is horizontal merger or horizontal integration. But when a company merge with a supplier, for example, then that is called vertical integration. Okay, that is called vertical integration. So you have the notes, you can read them in details. Then number C, examiner is asking you that if the merger is to take place immediately, calculate market values of the two banks before merger. So the market value of the two banks before merger is called the pre-merger market value. Therefore, to answer that, you need to ask yourself, I want to calculate the pre-merger market value. How am I going to calculate my market value? I've already demonstrated for you. To determine the value of a business, you can either use asset-based approach, you can use income-based approach, you can use dividend, you can use cash flow-based approach. So in any of those three approaches, which of them am I going to apply to solve this question? That's how you are the one that will be asking the question. So which of the method of valuation I'm going to apply in solving this question. When you look at the scenarios in the question, examiner mentioned dividend. Dividend is very common. Dividend was very common in this question. And you're also given the dividend yield, the cost of equity. So something should call your mind that, okay, it's like, since dividend is very common in this question, I can also see the value of dividend in the question. Value of dividend for both companies. I can see it there. So in this case, that means I'm going to use dividend yield basis to value these companies. I'm going to use dividend yield basis to value the business. If in the question, what is common, what examiner is emphasizing is on earnings, profit after tax, in that case, you are going to use any yield basis. If in the question, the examiner has given to you, you have been given price earning ratio. Examiner has given you price earning ratio. Even the examiner did not ask you to use price earning, but you can see price earning ratio in the question. It means that you are going to use price earning ratio to value the business. If in the question you are given balance sheets of the company, you are given balance sheets of the individual companies, then in that case you are going to use asset-based approach to value the business. So as a result, examiner will surely give to you the replacement value, the realizable value, the liquidation value, and all of that. But in this question, all those information are not given. So what is clear in this situation is dividend. So because examiner emphasized dividend, so because you can see in the paragraph after the table, you are told that both companies retain the same proportion of profit each year and are expected to do so in the future. While Michelin Bank's dividends are expected to grow at 12%, you can see emphasis is on dividend. Examiner also gives to you the growth rate on dividend for both Michelin as well as Dunlop. You are also told that after the merger, that is in 1 year's time, tire banks will retain 60%. Tire banks, after Michelin and Benz, once they combine together, they will now become tire bank. So after the merger, then the company will retain 60% of its earnings. So 60% of the profit after tax will be retained in the business. It means that 40% will be paid out as dividend. Examiner now mentioned that the post-merger dividends growth rate is expected to be 10%. So emphasis generally is on dividend. Therefore, we are going to value these companies using dividend yield approach or dividend yield basis. So without wasting more time, I will stop sharing this notes. Then I will move to working notes. Okay. Number A, requirements. This is solution to illustration number, which illustration is that? Illustration number 1. So solution to illustration number 1. Michelin. Bank. Okay. Now, number A, requirements. Examiner is asking you, what is the required minimum capital for Nigerian banks under the current dispensation? I would then say the current minimum capital the current minimum capital under the, let's say the current minimum capital is 25 billion naira. That answers that. No story. Number B, examiner is asking, what is the type of integration anticipated by Michelin banks? So when two companies of similar size operating in the same industry merge together, that is called horizontal integration. So I'll just say horizontal integration. Then number C. In the number C, examiner is asking you, if the merger is to take place immediately, calculate market value of the two companies before the merger. The market value before the merger represents the pre-acquisition value. So I would then say calculating pre-merger market value. So, like I explained to you the other time, how am I going to calculate the market value before the merger? The scenario of the question will tell you which method to use. If examiner is not magnanimous, like in this case, examiner was not magnanimous by telling us using a specific method. But in most cases, examiner may not tell you. However, how would you know that you're supposed to use dividend yield basis? Like I explained earlier, because the focus, the emphasis in the question was on dividend and then cost of equity. So you need nobody to tell you as a result of that you are going to use dividend yield basis to value the business. Okay, you are going to use dividend yield basis for the valuation. Therefore, as a result, I would then say value using dividend yield. Value is calculated as, you can see in the question, examiner has given to us growth rates. So that means dividend will grow. In that case, the current dividend multiplied by 1 plus the growth rates divided by cost of equity minus the growth rates. So this is the value. This is how we are going to calculate the value. DO is the current dividend of individual company of Michelin as well as Dunlop Bank. G is the growth rate. R is cost of equity. G is the growth rate, like I said. So R is the same thing as dividend yield. R is the same thing as dividend yield. In fact, let me help you further. I will say since emphasis is on dividend in the question, it's on dividends in the question, then dividend yield basis will be used to value, will be used to determine the pre-merger value, that is value, that is market value before the merger. Okay, so in this case, I would then say value equal to the current dividend multiplied by 1 plus growth rate divided by cost of equity minus the growth rates. Okay, therefore, I will do for each of the company. So starting from Michelin. For Michelin, what is the value of Michelin? So the value of Michelin will be calculated as, I will go to the question, what is the dividend of Michelin? According to the question, the dividend of Michelin is 1080, 1,080,000,000 naira, 1,080,000,000. is the value of Michelin, 1080. Multiply by, that's the dividend of Michelin. So multiply by 1 plus growth rate. So I will go to the question, what is the growth rate for Michelin? According to the question, we are told that the paragraph after the table, you are told that while Michelin banks dividends are expected to grow by 12%, those of Dunlop Bank are expected to grow by 4%. So 12% is the growth rate for Michelin. There will be 1 plus 0.12, that will be 1.12. Divide by cost of equity of Michelin. I will go to the question, what's the cost of equity of Michelin? If you look at the last paragraph, you are told that the dividend of both companies have been paid. The required rate of return is the same thing as cost of equity or dividend yield. So the required rate of return of ordinary shareholders of Michelin Bank is 15%. So cost of equity of Michelin Bank is 15%, Dunlop is 12%. So if that is the case, I would then say 0.12, 12%, no, 15, 0.15, minus growth rate of 12%, 0.12. So what's your final answer, please? Bring out your calculator. Bring out your calculator. So 1080 multiplied by 1.12 equal, then divide by 0.03 equal 40 billion 320 million. Here is 40 billion 320. That's that. I will do the same thing for Dunlop. For Dunlop Bank, the market value of Dunlop before the merger is equal to, I will go to the question, what is the dividend? The future dividend, the dividend of Dunlop is 1155. Here is 1155 billion multiplied by the growth rates. The growth rate of Dunlop is equal to 4%. So that will be 1.04. Divide by the cost of equity of Dunlop is 12%. 0.12 minus growth rate of 0.04 equal, carry your calculator, 1155 multiplied by 1.04 equal, divide by 0.08 equal 15 billion and 15 million naira. So here is 15 and 15. So that is that. We've just calculated the pre-merger value of Michelin and also Dunlop Banks. So that's what examiner asked you. Number C1, calculate market value. Calculate market values of the two banks before the merger. Bibli?
Question, sir.
Before you, there's Bibli waiting. I will come back to you. Bibli, go ahead. Bibli, are you still there?
Mister, I did not raise up my hand though.
Pardon?
I did not raise up my hand.
You raise your hand. That is showing you raise your hand.
Sorry, maybe it's a mistake. Let me do it.
It's okay. So, Mr. Gabe, go ahead.
Yes, sir.
Go ahead with your question. Yes, Mr. Gabe?
Hello, sir. Can you hear me now?
Yes, you want to ask question. Go ahead.
Yes, sir. The question we just solved, Michelin and Dunlop. Okay, now the figures we are using, 15% and 12%, is from the paragraph that said after the merger.
Yes.
After the merger, that's the last paragraph. Okay. And the question we are solving is centered on pre-merger. I'm saying it as if there's is there no issue there?
No. There's a difference. You know, you are given different numbers. You are given different numbers.
Okay. It's all right, sir. Thank you.
We are told in the question that, we are told after the merger, the dividend of both companies will require the return of this blah, blah, 15. Yeah. So we are told that after the merger, this is the story. We are told that after the merger, Bank will retain 60% of its earning, and post-merger dividend growth rate is expected to be 10%. So the post-merger, growth rate is that 10%. So the dividend of both companies have been paid. The required return of ordinary shareholders of Michelin Bank PLC is 15%. So cost of equity of Michelin Bank is 15%. The cost of equity of Dunlop is 12%. So after the merger, the cost of equity will now alter to 14%.
Okay, so 14 for both. Okay. Oh, thank you very much.
You are welcome.
I'm fine, thank you.
Sir, just to be sure, as of today, the required minimum capital is 50 billion. I don't know what you mean by 50 billion. It's not 50 billion, it's 25 billion minimum required capital in Nigerian banks as of today. Currently, as we speak, is 25 billion. Some of the banks, they have more than 25 billion, but that's why we say minimum capital. So it's not 50. The official capitalization done in 2005 is 25 billion, not 50 billion. Okay. Yes. So we have answered requirement number C1. So let's move to requirement number C2. Go ahead, Chiamaka.
Sir,
Yes, go ahead.
You answered my question, the 25 billion, right? But the recent news they brought, is it that it's going to take place next year or something like that?
That's my explanation to you before we solve this question. I said that currently, the capitalization that was done in 2005, the minimum capital requirement is 25 billion for commercial banks, 25 billion naira, and that still applies till today until effective April 1st, 2026, because banks are given 2 years commencing 1st of April 2024, ending 31st of March 2026. Immediately after that period, on 1st of April 2026, any bank that cannot meet up with the capital requirements may cease to exist or will combine with other banks in order to meet up. So as it is right now, it is 25 billion. But in the next 2 years, it will be 500 billion for commercial banks. So we are moving from 25 billion to 500 billion.
Thank you, sir.
You are welcome. So number C2, you have to determine maximum price Michelin Banks PLC will pay to Dolan Banks. So Michelin Banks is the one that initiate this transaction. So Michelin is the predator, is the acquiring bank, or is the acquiring firm. Now, the Dunlop is the acquired or is the target company in this case. So in that, examiner is now asking you to calculate maximum price to pay. So I would then say the maximum price that's Michelin, but let me just put it down. C high. The maximum price to pay. So the maximum price that Michelin Bank we pay to Dunlop Bank is the difference between the post-merger market value and pre-merger market value. Pre-merger market value of Michelin. Because Michelin is the acquiring company. Okay. This is shown, or this is calculated as follows. Okay, so we want to determine the maximum price to pay. So if that is the case, I need to know what is the post-merger market value. I already have the pre-merger market value of Michelin to be 40 billion and 322, so 320 million naira. I already have that. So I need to calculate the post-merger market value after the combining of Michelin and then Dunlop. What is the market value? So I would then say calculating post-merger market value. So to calculate the post-merger market value, examiner has given us the instruction on how we are going to calculate the post-merger market value. You can see in the last paragraph in the question, you are told that after the merger, that is in 1 year's time, Thayer Bank PLC will retain 60% of its earnings and post-merger dividend growth rate is expected to be 10%. So after the merger, the company will retain 60%. So what I need to do now is to add up what is the earnings of Michelin, what is earnings of Dunlop. So I'll get the total earnings, that is earnings before the merger. Then after the merger, we're now told that the company will retain 60% of the earnings. So it means that we are going to pay out 40% as dividend after the merger. So let's account for post-merger earnings. So I would then say earnings. To do this, I will say earnings for Michelin. The earnings of Michelin is your profit after, like I mentioned, profit after tax is the same thing as earnings. So 3240. Here is 32. Figures in million. 3240. Then for Dunlop is 1540. Dunlop is 1540. When you add it together, that's 4780. So this is the combined earnings. This is combined earnings. Earnings. So examiner is now telling us that after the merger, the company will retain 60%, then you paid out 40% as dividend. You can see examiner did not tell you that they are going to pay out 40%, but it is implied. You have to know the next thing to do. So if you are retaining 60% in the books after the merger, it means that 40% will be paid out after the merger as well. So I would then say dividend payout.
Hello, sir.
Yes.
Can't we use the retain earnings of the both companies instead of the profit, instead of the earnings?
Why do you want to use retained earnings? Why do you want to use?
Asking.
You can't use retained earnings now. It has to be the profit after tax. So examiner has given a specific instruction in the question. You are not asked to use retained earnings. There's a specific instruction in the question that Tire Bank PLC will retain 60% of its earnings. If examiner wants you to use retained earnings, examiner will mention 60% of the retained earnings. So there's difference between earnings and retained earnings.
Okay, sir. Thank you.
You're welcome. So, post-merger dividend will then be equal to dividend will be equal to 40%. This will be 4,780 multiplied by 40%, because you are retaining 60% of this, you are retaining 60% of the earnings. So that means you are paying out 40% as dividend. Therefore, what do you get? So 4,780 multiplied by 0.4 equal 1912. Here is 1912 in million, 1,912,000,000 naira. So that's the post-merger dividend. Now that I have the post-merger dividend, examiner also told me that post-merger cost of equity, post-merger growth rates. You are told in the paragraph after the table that while Michelin Branch PLC is expected to grow by 12%, those of Dunlop are expected to grow by 4%. Okay, that's not what I'm looking for. Now, yes, I've seen it in the last paragraph. You are told that earnings of the will retain 60% of its earnings, and post-merger dividend growth rate is expected to be 10%. Then after the merger, the cost of equity will be 14%. So in this case, I want to calculate post-merger market value. So post-merger market value will then be equal to, of course, is the same formula, which is current dividend multiplied by 1 plus the growth rate divided by cost of equity. What's wrong with you? Why are you moving? Did I touch you? See you. Okay. So minus the growth rates. So the same formula we are using. So in this case, I would then say equal to the current dividend, the post-merger dividend is 1912. Here is 1912 multiplied by the growth rates after the merger we are told is 10%. Post-merger dividend growth rate is expected to be 10%. So that will be 1.1 divided by cost of equity after the merger. We are told that after the merger, this will alter to 14%. So rate of return of ordinary shareholders will alter to 14%. So here will be 0.14 minus the growth rate of 10%. Final answer. So carry your calculator. 1912 multiplied by 1.1 equal divide by 0.04 equal 52,580. Here is 52,580,000,000 naira. So that represents the post-merger market value. Remember, we are calculating maximum price to pay. Now that I have post-merger market value, I also have pre-merger market value. I can then determine my maximum price to pay. I would then say maximum price to pay, which represents the difference between post-merger market value of 52,580,000,000 and the pre-merger market value of Michelin. Michelin is the predator, which is 40 320. So what's the hiatus? What's the difference? So I would then say minus 40,320 equal 12,260. 12 billion 260. This represents the maximum price to pay. So I would then say, I'm coming for you, Ne. The maximum price, Michelin, Bank, PLC, we pay to Dunlop Bank PLC is 12 billion 260 million naira. That's it. So that's the end of the question. We are done. We are done with the question. Yes, Ne, you're asking question. Talk to me.
Yeah, yes, sir. I wanted to know this formula,
Yep.
this R minus G,
Mm-hmm.
can K that KE minus G, can it serve in place of that R minus G?
It's the same
If
thing.
someone writes it.
It's the same thing.
Okay.
You can represent the letter as you want, provided you know what you are doing. So either you use KE minus G or R minus G. It's the same thing. So we are referring to
Okay,
the
sir.
same thing. Yeah.
Okay, thank you, sir.
I believe that's Grace, right?
Yes, sir.
Okay, you are the Nne. Nne. Yes, I'm writing. Don't even know what I'm writing. What's your problem, Elena? You are writing, you don't know what you are writing. That means you are writing rubbish. Shay? That means you are writing rubbish because you don't know what you are writing. Don't worry, just take your time. By the time you see, you take your time, you review what we have done and listen to the video, you know it better. It's very straightforward. All right, I've done my best to simplify it for you. No worry. By the time you settle down, you understand. Okay? Yes. Let's have one more illustration before we close for the day. We have spent almost 4 hours. So let's see. Let's have one more illustration. Pause first.